Good morning, my dear students. I am recording this video to teach about your first chapter of International Accounting course unit, that is Introduction to International Accounting. In this lesson, we are going to talk about the background of international accounting, the meaning of international accounting, definition, diversity of international accounting, and factors influence on the international accounting development and the different practices around the world. Let's move on to the lesson. First, we will discuss about background of international accounting. Dear students, you know the topic accounting is not new. It has been developed in the ancient period when the people used the numbers, count the numbers, and they record the numbers. From that, each country developed their own accounting practices, regulations, and rules. Therefore, the domestic accounting is influenced by the laws, culture, and the economy of every country. However, after a certain time period, the globalization facilitated to the countries to move beyond their country borders in order to access different resources like goods and services and finance. So these economics development increase the need of international accounting. So today the countries and the companies need to depend on other countries in order to access various resources. So the development in various economies of the world seem the ways of cross-border trading like import and export and the foreign direct investment in order to access the finance sources. So the local preparers of the financial statements have the mindset that their reports are being used globally. The reason is today the users of financial statements are globally separated. So thus globalization brought about international accounting. With this background, we will look on the meaning of international accounting. You know what is accounting. So we can define accounting is the process of identifying, collecting, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information to the users, to the various users. Here, the users in the sense, in the international accounting, the users globally separated. So the main difference between domestic accounting and the international accounting is the users of the financial statements. So the system of international accounting primarily indicates accounting in different types of environment. So with this meaning, let's look the definition of international accounting. We can define the international accounting in three different levels. Okay, so the first level, which is known as supranational level. So supranational level in the sense, supranational organizations developed the accounting principles, guidelines, standards in order to provide a common accounting practices. So the supranational organization in the sense, there are some examples, the UN, United Nations, OECD, Organization for Economic Cooperation and Development, and International Federation of Accounting, and so on. So the second level is known as the company level. So the companies who operate in the foreign countries also can have their own practices, their own accounting standard guidelines in order to measure the performance of their foreign units. So this is known as company level. Second level or the company level. And the third level, this is the broadest level, that is known as the level where the accounting systems of different countries are compared in order to understand the similarities and differences between the different countries' accounting system. So here, the cross-countries comparison of rules related to financial reporting, for example, the rules related to measurement of PPE, property, plant, equipment, or the income and tax rates, or they can compare the requirement of becoming a member of the national accounting profession. So this comparison level known as the third level or the broadest level. So we have discussed the background of international accounting, and then we have discussed the meaning of the international accounting and the definition. In your mind, there are 3 levels. In 3 levels, we can define international accounting. So the next thing we will move on, the overview of international accounting environment. So today, you can see the economy. The world economy is integrated. The reason is globalization. So no one country can survive independently. So every countries need to depend on others in order to access various resources. So these situations facilitate to the international trade in the subsequent recent years. In addition to that, in the recent 2 decades, the foreign direct investment has also increased. So the countries, they right to achieve that, they right to attain more and more financial sources from the foreign countries. In addition to that, the aggregate revenues generated by foreign operations exceed the revenues generated by the local operations. So these points highlights the need of international accounting due to this international accounting environment. In addition to that, there are 77,000 MNCs, multinational companies in the world, and there are 770,000 subsidiaries in the world together generate 10% of global domestic product. So it means these global organizations contribute by a huge amount to the global economic, and the headquarters of most of the MNCs is situated in the developed countries like US, Japan, and the European Union. However, we can't say the MNCs are more large than the other companies. There are some large companies, those companies don't have any foreign operations. In addition to these MNCs, today the companies who operate in the foreign countries are trying to cross-list their stocks in the other stock exchange in order to access more and more finance. Move on to the factors influencing international accounting development. There are so many factors which influenced on the international accounting development. We will discuss one by one. The first factor is external finance. You know, the company listed in stock exchange can raise their finance by issuing their shares. However, if the company depends on these domestic shareholders, they cannot collect more money. Therefore, the companies today are trying to collect more and more capital in order to widen up their company size. But the limitation is how to satisfy the expectation of foreign shareholders as well as the local shareholders. So the company should satisfy the foreign shareholders' expectations while satisfying the domestic one. So this would call for going beyond domestic expectations and customs in providing financial reports. The second factor is legal system. The legal system of countries are different. Some countries having the court law system and some countries are having the common law system. So the countries who have the court law systems practicing legalistic orientation, and the countries having the common law system practicing the non-legalistic orientations. So based on these different legal systems, the organizations and countries cannot have the different accounting practices. Therefore, these factors also lead to the development of international accounting. The third factor is political and economic ties with other countries. So the political and economic ties among nations have forced accounting practices to become more similar. Consequently, the International Accounting Standards Committee was developed in order to develop international financial accounting standards and sought for the wider possible acceptance and use. Move on to the next factor, level of inflation. You know, the inflation level of countries are not same. So, the country who experienced low level of inflation can adopt the cost principle, historical cost principles in their accounting system. But if a country experienced the huge level of inflation rate, they cannot depend on the historical cost principles. For instance, the Germany and Japan hold strictly to historical cost principles because they have historically experienced very little inflation. On the other hand, some South American countries, they revived by inflation programs for years and long age abandoned any attachment to strictly historical cost. They measure their assets based on the current market price, which means based on the fair value pricing. So the last factor we are discussing is size and complexity of organization. So the size and complexity of organization are not the same. Some organizations are large, some organizations are medium, and like the small organization. So if a company is large, that's a situation they have to deal with more and more complexity and the more and more accounting issues. So these companies may have foreign operations. Therefore, due to this large size of organization, the international accounting also developed. So these are some of the factors which facilitate to the international accounting development. Next topic, we are going to discuss about worldwide accounting diversity. Do you think the accounting reports prepared by the different companies over the globe are similar? Absolutely no. The reason is there's a diversity in the accounting system of different countries. Let's see the diversity exists across the countries. So these diversities respect to the first one, the form and content of individual financial statements. So the format of the financial statement is not same over the globe. And the second one, the rules used to measure the assets, liabilities and equity and recognize those revenues and expenses are not same. And third one, the magnitude and the nature of the disclosure provided in a set of financial statement also differ. For example, there are some mandatory disclosures in the developed countries, still be a voluntary disclosure in the developing countries. So these differences causes to accounting diversities over the globe. So the next we will talk about some evidences of accounting diversities with example. So the first one is different in format and terminology. So example include the presentation of asset, order to liquidity or fixity, reserve may exceed or may not exceed. In Sri Lanka, we are using the term non-current assets, but in other countries, still they use the term fixed asset in order to represent fixity of the asset. So the second one, the difference in recognition and measurement. You know, some countries are based on the historical prices and the other countries they are based on the fair values in order to recognize their asset value. For example, USA and Nigeria are not allowed to report property, plant and equipment at amounts greater than historical cost. But companies in Europe are allowed to report their assets on the balance sheet at the market values. So these differences are existing all over the globe. Okay, the last topic but not least of this session is problem posed by accounting diversity. So we have studied what is accounting diversity and the problems of the accounting diversities are so many. For example, we have already discussed the companies or the countries cannot operate independently. They are dependent on each other. Therefore, the companies or countries, they can't have different accounting practices, so that create the barriers for their growth. So the problem posed by accounting diversities, the first one is difficulties of preparing consolidated financial statements. For example, if a company has subsidiaries in the other countries, they have to prepare the accounting reports in two countries' accounting system. So one is parent home country, another one is the subsidiaries company's country. When they merge those reports into one, that is known as the consolidated financial statement. When they merge, they may face some difficulties on the measurement and the recognition of assets, liabilities, income and expenses. So the second problem is increased cost of cross-listing of companies. So if there are any diversities in the accounting systems, companies need to list their stocks into two stock exchange or more than two stock exchange. So it creates more and more expenses. So we have discussed already, shareholders' expectations are different based on their country of origin. Therefore, company need to disclose listed in two stock exchange in order to satisfy all the shareholders. And the third point is difficulty of comparison of financial statements. So we have already discussed the format, terminology and the measurements. All the things are different country to country and the accounting systems of different countries. Therefore, the global shareholders cannot compare easily the different countries' financial statements. So that is also create the problems. And the final one triggers financial crisis. So if there are any issues on the disclosing financial information, companies cannot show their true picture to the shareholders. As a final, it will lead to financial crisis. Not only these four, there are so many problems due to these accounting diversity. Therefore, the world organizations and other supranational organizations are trying to commonize these accounting diversity. So we will learn the commonization of accounting diversity in the next lesson. Dear students, if you have any questions or clarifications, leave your questions below this video or else leave your questions on the LMS discussion forum. Thank you so much for listening to me. Bye-bye.